In the grand theater of global finance, where fortunes are forged and shattered in the blink of an eye, a silent, relentless transformation has been underway for decades. Before the era of artificial intelligence as we know it, a new vanguard of pioneers emerged, the Quants. These were the mathematicians, physicists, and computer scientists who dared to look beyond the chaotic symphony of the trading floor, seeking order in the apparent randomness of the markets. Armed not with intuition honed over years of floor trading, but with sophisticated mathematical models and the nascent power of computation, they embarked on a quest to decode the market's intricate rhythms. Their domain was not the boisterous pit, but the quiet hum of mainframes, their language not shouts and hand signals, but lines of code and complex algorithms. They saw the financial world as a vast data set, ripe for analysis, a puzzle waiting to be solved by logic and processing power. The promise was revolutionary, decisions executed with inhuman speed, precision unmarred by emotion, and the potential to unlock profits hidden from the human eye. This was the genesis of speed, the first tentative steps towards a future where machines would not merely assist, but actively sculpt the flow of global capital. The clatter of the ticker tape was slowly giving way to the whisper of terabytes, heralding a paradigm shift that would forever alter the landscape of Wall Street and beyond. But this was only the prologue. The true algorithmic arms race was yet to begin. The foundational work of the Quants ignited an arms race, a relentless pursuit of ever faster, ever smarter trading systems. As computational power exploded and artificial intelligence evolved from theoretical concepts to practical tools, Wall Street transformed into a high-tech battleground. Machine learning algorithms, inspired by the intricate workings of the human brain, began to sift through mountains of data, identifying subtle correlations and predicting market fluctuations with an acuity that outpaced human capabilities. Neural networks, with their ability to learn and adapt, became the new engines of high-frequency trading, or HFT. In this domain, victory is measured in microseconds. Trades are executed at speeds far exceeding human perception, driven by algorithms housed in colossal data centers, strategically positioned as close as possible to the exchange's own servers. These digital fortresses are interconnected by a global web of dedicated fiber optic cables, pathways through which trillions of dollars in transactions pulse every single day, nearly at the speed of light. The quest for the ultimate trading advantage has even reshaped our physical world. Firms invest fortunes to shave milliseconds off transaction times, laying new cables or utilizing microwave transmission towers for a marginal speed boost. The stock market is no longer confined to a physical floor. It has become a deterritorialized global consciousness, an ever-watchful AI that never sleeps, constantly scanning, analyzing, and acting. This algorithmic arms race has created a market of unprecedented efficiency, but also one of breathtaking and at times terrifying complexity. This intricate web of algorithms, while designed for profit and efficiency, carries within it the seeds of its own potential undoing. The very speed and interconnectedness that define modern markets also make them vulnerable to new, unforeseen dangers. The financial world has been jolted by flash crashes, sudden, inexplicable market dives triggered not by human panic, but by rogue algorithms or the chaotic, unpredictable interactions between countless automated trading systems. These digital tempests can erase billions in value within minutes, only to vanish as mysteriously as they appeared, leaving regulators scrambling for answers. Beyond these accidental conflagrations, the specter of deliberate manipulation looms large. Sophisticated AIs can be programmed to execute predatory strategies, spoofing the market with phantom orders, triggering stop-loss cascades, or exploiting microsecond vulnerabilities in ways that are virtually invisible to human oversight in real time. The lines of accountability blur. When an algorithm causes a market disruption, who bears the responsibility? Is it the programmer who wrote the initial code, the firm that deployed the system? Or does the AI itself, in its complex learning, develop a form of emergent, unintended agency? The ethical quandaries are profound. We've built machines designed to relentlessly pursue profit, operating in an environment where information is power and speed is paramount. But have we adequately equipped them with the digital equivalent of caution, or a sense of the broader systemic impact of their lightning-fast decisions? The phantom in the wires is a constant reminder that our sophisticated tools may possess a complexity that sometimes eludes our complete understanding and control. As we stand on the threshold of an even more automated future, the evolution of AI in finance continues its relentless march. The next frontier involves artificial general intelligence, or AGI-like systems that don't just execute strategies, but autonomously learn, adapt, and invent entirely new paradigms for market interaction, potentially far beyond human intuition or even comprehension. These systems could become the ultimate oracles, capable of predicting economic trends with uncanny accuracy. Or they could become the new overlords, making decisions that impact global economies with little to no human intervention. What then becomes the role of the human trader, the seasoned analyst, the financial regulator? Will they be relegated to the sidelines, mere observers of a market dance orchestrated by silicon minds? Or will new synergies emerge, where human oversight and ethical guidance work in concert with AI's raw processing power? The challenge lies in harnessing this immense capability responsibly, in building frameworks that ensure transparency, fairness, and stability. The algorithmic grip on our financial destiny is tightening. The future of the market is inextricably linked with the future of artificial intelligence. Whether this leads to an era of unprecedented global prosperity and stability, or to new forms of volatility and inequality, depends entirely on the choices we make today, and the wisdom we embed into the digital deities we are creating.